so much. We're blessed with a new chair of the Fed, and she's a wonderful economist. The good news is she's great. The bad news is she forgot to tell you 10 things. And this is what I'm going to talk to you about. And maybe I can temper some of the enthusiasm that you all voted on. And so I'm going to roll quickly through 10 ideas, and then maybe it will be the time for all of you to have a view, to have an opinion, and maybe to act differently going forward. Here we go. Welcome to the bubble. So the old textbook in terms of Keynesian economics was that when faced with a crisis, spend. And everyone remember the old FDR program where you hire people, you spend money on infrastructure. And that's all good, but it's very slow and it doesn't help banks. And so the policy decision that the Fed was faced in 2008 was, how can we shore up the bank and how can we restore faith in the market quickly and efficiently? And they came up with quantitative easing. Now, quantitative easing worked better than any of us expected. But what it did is it drove yield to levels that none of us thought were possible. 10-year rates in Germany, 0.23. 10-year rates in Switzerland, minus 0.2. Think about this one. 10-year rates in Japan, 0.4. And my favorite, 10-year rates in Italy, 1.2%, coming from 8% in 2011. And so what it means for all of us here is that discount rates are incredibly low. That makes every single asset go up. And so when I talk of asset price inflation, you can say that bonds are very expensive, equity are very high, real estate seems to go up every single day, real assets are incredibly high by any margin, maybe not commodity, that's an interesting topic to have, but the main driver has been lower interest rate. There's a very good paper on the website of the Bank of England about the impact of QE on the gilt market. It's something like 75 bips to 1%, but it is a really, really important fact. Bubbles are complicated. They go up. It's very hard to predict if and when they burst. I would urge anyone to be very cautious. Think about two theories about bubble. The behavioral finance one, where people get overexcited about markets, that's fine. It's hard to prove, but it's one classical explanation. The other one, which is more complex, is that things get expensive when the uncertainty about technology is so big that you can have wide variation in terms of valuation, and technology is one of them. And so, for example, I think you can look at valuation of tech stock and say the uncertainty about the winners and the losers is just so big that it warrants in a rational market high prices. Number two, risk premium and leverage. Well, here's the strange thing, is that leverage really has not gone down since the financial crisis. I have some number for you. Total debt to GDP went from 380% in 2007 to 415% today. Now, what has happened? The government essentially took on the debt. And you had a big transfer from one side of the economy to the other. And so the issue of deleveraging and what to do about it is going to be central for the rest of this decade, if not more. You have a lot of countries, Italy is the perfect example, who are facing high debt ratio, deficit on the current income, fiscal policy with little room to maneuver. And so the challenges in terms of making sure the budget balances are quite complicated and quite difficult. The equity risk premium is very low. I'm glad to know that everyone is very excited about equity, and maybe that's very much right. But equity risk premium is at 2.5. And 2.5 with rates which are very low by any measure and by any model in terms of term structure of interest rate. And so we're facing a risk structure which none of us have seen before. And being humble in front of it and being cautious about any prediction has to be the driving operating member. That being said, rates are too low, and that has sort of two ways of ending up. Either rates go back up, in which case risky assets go down by the simple mechanism of discounting cash flow, or rates tell you what the future looks like. The future looks like there is no growth, in which case the earning picture is overly optimistic, and so valuation on equity will have to correct. Remember the argument from Robert Shiller from Yale, the trailing PE in terms of the US stock market are quite high, something to think about. I always give the example of McDonald's, 18 times PE, 3% dividend yield, grows 1% above growth in the world. There's only so many McDonald's you can build in China. What happened? There's two ways to look at this. 3% dividend yield versus 10-year rates in the US at 2.2, it's cheap, and so that warrants the 18 times earnings. Flip side, 18 times earnings for a company which grow at 3%. So you see the conundrum. The end of neo-Keynesianism. So when you look at the US policy since 2008, it's been very good for risky assets, and in the war of competitive devaluation, it's been good, strangely, for the dollar in the end. And that may have been an effect that I think the US administration hadn't really thought about. But the strength of the dollar right now is something to be reckoned about. And I think that's the reason why the US stock market doesn't like what they're seeing, simply because you've seen the fall in the euro and the fall in the yen over the past couple of weeks, which have been quite dramatic. The neo-Keynesianism policy have been very good for the job market. And I think the most surprising statistics in the US is that jobs are at 5.5% unemployment, which is way, way, way below any of our expectation in terms of the ability to create jobs in the US. It's been good for pension fund and an insurance company. Risky assets go up, that's good for everyone. It's not clear to me whether it's been good for banks. And it's a topic I'm going to come back to, but the reality is the banking system has been shored up pretty well, partially through tough regulation, partially through equity issuance, partially through better practice. But there is an issue I will come back to, is the issue of liquidity. And there are issues that Keynesian economics now cannot help. You've done as much QE as you can. Now Mrs. Yellen has to take the tap back and stop printing money. Can the US and the world grow without a major injection of QE? And I think the answer is we don't know. And you need gain in productivity. It comes from labor or from capital. It's a question of how much one can improve either one of them, and I think the picture is not as clear as I would like it to be. And at last, you need supply side reform. And so when you look at continental Europe, with the exception of Germany, it's not about buying bonds. You know, we're glad that Mario Draghi is in a program of QE, but at the end of the day, you need really deep structural reform. Globalization is going one way. They are manufacturing and jobs being created in Asia and Latin America. Every single company needs to compete against the new world. And as such, structural reform needs to be happen. I think we just heard about pension, but I think there are many other areas where structural reform needs to happen. Number 4, you speak Japanese. Well, old people, like both of us, remember what happened in the 80s, where Japan was great. And I remember being in the late 80s with Hank Paulson trying to figure out how we could ever fight at Goldman Sachs, the Japanese bank. And it turned out that the 90s proved to be a very different picture. But what happened at the end of the 80s is the Japanese stock market had a crazy valuation. But when the market started falling and the GDP started falling, everyone thought this was a normal contraction. No one sort of knew the terrible shape that the Japanese banking system was in. And it took literally 15 years, from 1988 to 2003, when you saw massive capital raised by the Japanese bank, to essentially show up the Japanese banking system through merger, through capital issuance, through nationalization of some of the banks. And the understanding of the Japanese situation is that the situation wasn't dealt with quickly enough. And so when you look and contrast this with RBS, for example, which is the closest example that you can think of, the future of RBS is clear. It was a bank which did things they should not have done. It's now a commercial bank. The investment bank is being reduced. And very quickly, it would be business as usual. And so the speed at which we have all learned from Japan is actually quite interesting. Japan is interesting. I would urge every one of you to go to Japan and see, despite a very high debt to GDP ratio, and I slightly contradict myself, what a well-run country can be. And if momentum, and if you believe in momentum, it's a market which is going higher, which is not the fact of so many markets. Number 5, the French connection. It was hard for me not to talk about this. I come from the border of Germany. It's a place called Alsace. My family was in the textile business. Don't get too excited. It doesn't end well. So textile, essentially, I take a step back. It's king cotton coming from the south of the US, going to Manchester and Liverpool in 1780. They manufacture until the Civil War fantastic textile, and these places are booming. The French don't react too quickly, no surprise there. They don't start manufacturing in 1780, they start manufacturing in the east of France around 1830, 1840. So it takes a while. But there's one great thing which happened. My region, called Alsace, becomes part of Germany in 1871. Why? Because France loses a stupid war, which seems to be a common theme when you're French. And so all of a sudden, Alsace becomes part of Germany, and you have a whole new market which opens up. And that's wonderful. That creates jobs. That's the Protestant ethics. That's essentially a whole market which goes very well until 1914. And from 1914 to today, it's a terrible straight line down. And it is every single lesson you ever had about globalization and about worldwide competition. So textile takes a first real big cut in 1929 and then slowly die. And the last textile manufacturer gives up in 1975 or something like this. The other big employer is Peugeot, the French car company. Most likely you haven't seen many Peugeot on the road here, and if you have seen them, they're mostly at the service station, which explains the stock price. But France has to face really big structural reform, new labor market, lower health spending, higher retirement age. There is no way you can retire at 55 and live for another 40 years. And obviously, an absolutely enormous number of civil servants, which needs to be addressed through an incredibly courageous number of decisions. And so the French case is interesting because it is more than economic policy. Those are very deep social reform that a very brave politician will have to make, and I am not sure that they will happen. Number 6, the machine 1, human 0. It's a football score. And so we have an institute at Oxford called the Man Oxford Institute. One of the academics is a fellow called Mike Osborne. Mike Osborne is a machine learning specialist. He's written a paper that you may have seen reference to in the press. Based on his analysis, he thinks that in the US, 35% of the job will disappear in the next 30 years. And what he looks at is he looks at routine versus non-routine job and manual versus cognitive job. And obviously, he thinks, not surprisingly, that the routine manual job will be replaced by machines slowly but surely. He fully recognizes that many other jobs will be created, but it tells you that the machine is becoming more and more important in a lot of things we do. And so the shelf at Walmart and at Sainsbury will be soon filled by machine. when you go to the checkout, you won't speak to anyone. You will just scan your grocery like you do at Sainsbury right now, and so on and so forth. And I think this trend is incredible. In my last point, I will talk about the Google car and what's happening in Palo Alto, which obviously is highly speculative but highly interesting. But this issue of machine actually is also interesting for the investment management industry. Now, I have some bias in the sense that we do have a big quant business, but what was interesting is when passive started, no one thought that passive was going to last. And the reality is the rise of passive investment is without any stop. Every single year, you have more money going into passive management. And I think for quant, it's going to be something very similar. People will look at quant and say, there is space for everybody. There is space for good fund manager. But they will look at performance and some of the numbers we've put together over the past few years and say, you know what? We need to put more money into quant. And I think one of the things you will see is slowly but surely more money being managed by a computer. And some of it is actually pretty straightforward. Computers are much better at executing transactions than human beings. It's cheaper, it's faster, and the client is better off. And so if you keep in mind what the FCA wants, the concept of best X is really achieved by computer trading. Number 7, it's a famous movie that some of you may remember with Daniel Day-Lewis, There Will Be Blood. So in this movie, he is someone who looks like John D. Rockefeller in 1880, and the birth of Standard Oil, and obviously the practice he had in the oil industry at the time weren't something to be proud of. But we think that oil is going to remain low and remain low for a while. And it takes a very brave man to make any prediction about oil. It takes even a stupid man to make prediction about oil. But the reality is the supply of oil is going to remain high. And the technological change in terms of drilling are truly incredible. And so one of the things we believe is that offshore is going to be far more unattractive than onshore. You're better off drilling in North Dakota than in the middle of the Gulf of Mexico or in the Gulf of Norway. And the differential in pricing in terms of what's happening in the oil industry is so complex and so interesting that there will be a lot of money to be made. And so what I do think is that when you look at the high yield market in the US, 15 to 20% of the high yield market in the US is in the energy and power sector. Obviously, yields have gone up. There are some situations which are distressed. We think it's a great opportunity and that the alpha in terms of picking opportunity between high yields and between stock is going to be enormous. It's very big, it's very liquid, it's very complex. Every place is different, every state is different, every cost in terms of drilling oil is different. You have to do a lot of in-depth analysis. That's exciting. That's a good place to put money. Number 7, please send the check to the kids. You have two things which are very clear. One, that when you look at voting pattern, young people do not vote. Older people vote, point one. Point number 2, that if you are lucky enough to be 25 in this room, you will live to be 90 to 100. You will work until you're 75, and you will pay for the baby boomers. And one of the questions which is going to have to be answered is who should pay for the leverage and what's the fair split of duty in terms of a population where people who may have already retired have benefited a lot from the growth which came with leverage. You take a country like Italy, for example. Either Italy is going to be much more competitive, which means a euro at 0.8, or they will have to restructure the debt eventually, or you will need wealth tax. And in the third situation, I think the answer will be very different, whether you're 25 and whether you're 75. And the same question, I think, is going to rise in Spain. You look at Podemos, this political party. This is the rise of people who say, we're 25, why do we have to pay for past mistake. I don't pretend to have an explanation nor a coherent theory about this, but I think this is going to be a big theme in terms of what to do and in terms of the pension industry also. Number 9, liquidity and bank regulation. This is a very straightforward point. Liquidity is worse than it used to be 10 years ago, and I can give you 2 examples. The Treasury bond market, where you had a spike in rates when Janet Yellen spoke once, which made absolutely no sense. I don't think I had seen that for quite a long time. And the credit market, where liquidity is clearly much lower than it used to be 10 years ago. We've achieved quite a bit in terms of having banks which have enough Tier 1 and Tier 2 capital. I think you'll see this here, a plethora of Tier 2 issuance from every single bank in Europe. That will be good in terms of investment opportunity, by the way, in terms of sub versus CoCo versus Tier 1 versus Tier 2 versus hybrid and so on and so forth for people who trade this. But the reality is banks commit far less capital than they used to. Everyone in this room who's involved in credit knows that. And the US high yield market, where you have a lot of retail money, will be both a risk and an opportunity. And so I remind every one of you that a lot of money has been raised in mutual fund, what's called 40 Act in high yield in the US. When it makes money and it gives a 6% return, that's great. The moment that rates go up or yield widen, you have a lot of money which comes out. And I think not having banks will essentially have, or having less banks will essentially create both risk and opportunity for people in this room. My last point, the sun also rises in Palo Alto. Palo Alto is in many ways the center of the world. It's where Stanford University is, and it's where a number of incredible innovative companies are. And this is the optimistic part of my speech. We are in something which looks like the second industrial revolution. And I will take 3 examples. This idea of sharing. It's not about delivering a book faster like Amazon, it's about Uber. Now, why is Uber interesting? Uber is interesting because it allows people to work, it allows people to share car, it will change the way we live when in 10 or 20 years we'll have Google Car in town. It will change the cost of infrastructure in terms of real estate, in terms of what's worth in terms of parking lots, for example. And this revolution, as much as I want to be able to predict them, will be enormous. There's another company called Airbnb, which is about essentially hotel rooms and renting your room, which is doing absolutely great. You rent your room in your house, you're being rated, okay? And it's the customer-to-customer segment where you have a truly revolution in terms of sharing goods, sharing resources. Energy will be the last sector where 15 years from now, you'll have people having solar panel on their roof. They'll be able to store energy. They'll be able to sell it back to the grid. And the grid will become some kind of a common good where people will be able also to provide energy. 2 other companies, Palantir, it's a private company. You go and see them in Palo Alto, and you see what data is all about. And so you're sitting there in Stanford, and you can see real-time customer pattern in terms of how people spend money. And if you want to know how a 25 to 30-year-old woman spends money in San Francisco right now, because they have data and cross-sectional data, which are incredibly complicated to put together, they have this picture of what's happening real-time, which is truly amazing or truly frightening, depending on how you want to look at it. But they're able to take data at the same time from credit card, from social media, from news, and just put them together and give you a really, really real-time picture of how people act and how they spend money. And it's truly amazing. And the skill is an ability to manipulate big data like absolutely no one else. And the last one, which is the obvious one, is the success of Facebook. And for every person who had doubted about Facebook, they have 1.3 billion monthly users. Revenues are going up the roof. And for all of us who thought that this was something for our kids to waste their time instead of doing homework, they've been incredibly successful. And so on this note of optimism, I'll thank all of you, and I will go and sit down.